If you've ever felt that investing is just way too complicated or maybe something only for the experts, then this guide is for you. We're going to break down the absolute essentials for anyone starting from scratch.
Look, we're not here to give you financial advice. Our goal is to equip you with the fundamental knowledge you need to make your own informed decisions. We'll cover 5 key areas, and we're starting with the most important rule of all.
Okay, let's dive right in. Before we even talk about putting a single penny into the market, we have to talk about when you absolutely shouldn't invest. Seriously, this is the foundation you've got to have in place first.
Now, investing definitely has risks, no doubt about it. But there's also this hidden risk in just doing nothing, leaving your money sitting still. Over time, the rising cost of everything, that's what we call inflation, means your cash actually buys you less. The money in your savings account today won't stretch as far as it did a decade ago.
So this brings us to the golden rule. It's got 3 steps, and they are non-negotiable. First, get rid of high-interest debt, like credit cards. The interest you're paying on that stuff will almost always wipe out any investment gains. Second, build yourself a safety net. We're talking an emergency fund with 3 to 6 months of living expenses. This is your cushion for when life happens. And third, and this is a big one, only invest money you are sure you won't need for at least 5 years. If you can't check all 3 of those boxes, you're not ready to invest just yet. And that's okay.
All right, so let's say you've got the golden rule covered. What are you actually buying when you invest? Well, it pretty much all boils down to 2 basic building blocks: shares and bonds.
First up, shares. When you buy a share, you are literally buying a tiny piece of a business. That makes you a part owner. So how do you make money? 2 ways. The price of your little slice can go up as the company does well, or the company might give you a share of its profits. We call that a dividend.
This is so important because it helps us bust a huge myth. Investing is not the same as gambling. See, gambling is a zero-sum game. For you to win, somebody else has to lose. Investing, on the other hand, is about owning a real asset. And as the whole economy grows, everyone who owns a piece of it can win together. It's not about beating someone else, it's about sharing in the growth.
The other main asset is a bond. Now, if buying a share is like being an owner, buying a bond is like being a lender. You're basically giving a loan to a company or a government. In return, they promise to pay you regular interest and then give you your original loan back on a specific date in the future.
And here's the core trade-off, all in a nutshell. Shares are kind of like a rocket ship. They have higher potential for growth, but they also come with more risk. Bonds, on the other hand, are more like a shield. They're predictable, they're safer, but you usually get lower returns. It really is that classic difference between being an owner versus being a lender.
Okay, so you could just go out and buy a share in one single company. But what happens if that company tanks? Yeah, you could lose everything. This brings us to a much smarter and safer way for beginners to get started. For a beginner, trying to pick individual winning stocks, well, it's like walking a high wire without a safety net. You're putting all your hopes in one basket. And if that basket drops, your investment could be completely wiped out. Yikes.
The solution is something called a fund. Just think of it like a pre-made basket full of investments. So instead of buying one share in one company, you buy one little piece of the entire fund. And that gives you a tiny slice of everything inside that basket. We're talking maybe hundreds of different shares and bonds all at once.
This whole strategy is called diversification. And honestly, it's the closest thing to a free lunch you'll find in investing. By spreading your money out, you dramatically reduce your risk. If one company in your basket goes bust, who cares? You still own hundreds of others. For a lot of beginners, a simple tracker fund that just follows a big market index, like the S&P 500 or a global tracker, is a really popular way to start.
Now, funds mostly come in 2 flavors. You've got active funds, run by a manager who's trying to pick winners and beat the market, but that costs more in fees. And then you have passive funds or tracker funds that just use a computer to copy a market index. For most beginners, passive funds are a fantastic choice because they're cheap, they're simple, and they give you that instant diversification we were just talking about.
So, you've bought a fund. You diversified your risk. That's awesome. But that doesn't mean it's going to be a totally smooth ride, especially when you're just starting out. You have to be prepared for the roller coaster. This is the big one. This is the fear that stops most people from ever starting. What if I put my money in and the very next day the market just crashes? It's a totally valid worry, but it's all about your perspective.
Looking at your investments day to day, it's a recipe for anxiety. The market zigs, zags, it's all over the place, it's volatile. The absolute worst thing a new investor can do is get addicted to checking their balance every single day. You will drive yourself nuts.
And this chart, this shows you exactly why the long-term view is everything. Let's say you started with $1,000 10 years ago. In a top savings account, it wouldn't have even kept up with inflation. You'd have actually lost buying power. But that same $1,000 in a simple global tracker fund, it could have nearly tripled. Time is the magic ingredient that smooths out all those scary bumps in the market.
Okay, so if you've checked the boxes on the golden rule and you're ready to play the long game, how do you actually do it? Let's walk through the practical first steps.
First off, how you hold your investments really matters. In the UK, for instance, a lot of people use something called a stocks and shares ISA. Think of it like a special tax-free wrapper that you put your investments inside. Most countries have something similar like a 401k or a Roth IRA in the US. The key thing here is to look for these kinds of accounts where you live because paying less tax can give your long-term returns a massive boost.
So where do you actually buy your investments? Well, you've got two main options. A robo-advisor is amazing for beginners. It just asks you a few simple questions and then builds a portfolio for you automatically. Or you can go the do-it-yourself route with an investment platform and pick your own funds. Whatever you choose, the most important thing is to keep an eye on the fees. Lower fees mean more of your money stays in your pocket, working for you.
You know, there's always going to be uncertainty in the world. Always a reason to say, I'll just wait for a better time. But as the old saying goes, the real power of long-term growth is a force that rewards the people who just get started.
So, I guess that's the ultimate question, isn't it? Investing isn't some get-rich-quick scheme. It's a long-term plan to build a better future for yourself. It takes patience and it takes discipline. So the question I'll leave you with is, are you ready to think for the long term?